2008. I know, hopefully your screen's big so you can see this. It's 2008. This is going all the way to 2009. What I want to talk about is the behavior we operated with in 2008, and tell you how that plays into today. And let me stop for a second and say something that I think is important. In my industry, it seems to me, meaning financial, wealth management, etc., it seems like there's a lot of conversation on either fear or greed. I try very hard not to let either one of those become the focal point of what we're talking about. So my goal here is not to cause anybody to become afraid or uncomfortable this evening or as they watch this anytime in the future. But my goal is also not to say we should be greedy either. It's to try to figure out a professional balance on how to manage money wisely, understanding that there are all kinds of impacts that could be affecting the decisions you and I are making. So what I want to share with you is how we handled 2008. 2008 was a pretty difficult time. Let me just show you from the beginning here. So we go to the peak of that and we pull it down to the bottom of the market, which is right over here if you take a look at it. What that is the market was down about 57 to 58% during that time frame. And that time period is from 2007, roughly October, November, to about February of 2009. Now, from this piece here, and we had seen the market go up, up, up. It'd been a nice return after the 2001 market decline, the bull market or the bear market that happened there. But when we saw it happen, and there was a lot of information out there trying to figure out how good or bad it was, the behavior was, and you'll notice right here, it broke right through the 200-day moving average and fell below it. This is that red line again. You'll notice that earlier in the year it had done it before, but it came right back up again, and this time it did it a second time. And so when this happened, this is from October to November, a 1 month period of time, there was a lot of seeking of information. What do we do? What's going on? What's happening in the markets? And there was as many new ideas about what's going on as there was opinions. And so you're trying to figure out through all this information what makes the most sense. We had the market quickly though turned around, broke above the 200-day moving average as well as the 50 and the 20-day moving average, broke up here. And I know I'm using lots of terms, it just went up and broke above the highest mark and then turned around and went down again. Now, this is a terrible term. I don't know why it's used, but it is what it's called. This in investment terms is called a dead cat bounce. You don't always know it's that until you look backwards, but it's basically the market goes down and then all of a sudden, bang, it heads back up again. And then it turns south and it goes down again. Now, I will tell you, I wish, knowing what I know now, that we had caught right there and said, we're gonna get out. That would have been the best thing to do. But again, hindsight's always 20/20. We didn't know the market was gonna go down like it was. And we did not have all that information in November that we had by the time we got to this next moment here, which I'm gonna explain in a minute. And so we stayed, we were relatively conservative, but we still had some aggressive growth clients. And so we decided to go ahead and ride this out and waited for the next bounce, which happened here in the hit the top in May of 2008. So we're going from October of 2007 to May of 2008. And so that's an eternity when you're watching the market do this. And it was still fresh in people's mind, including mine, of what had happened in 2001 and 2002. And so there was a lot going on there. But by the time we got to 2008, we knew enough information about the bond markets, the mortgage debacle, all the things that were happening, that when it came up, somewhere in this time here, myself, our team, we decided that if it didn't break through the 200-day moving average and head north, we were going to go ahead and pull back and get more conservative, which it went up and then went down. And at that point, we started selling things to get more into either defensive positions or cash positions. Now, a 10% drop is what's called a correction. And so it made sense to do that, so we did. But what also is important to understand is we did not experience a lot of this. Matter of fact, we experienced very little of this. We weren't totally in cash or totally in defensive positions because nobody still knew what was going on for sure, but we were able to avoid a lot of this. So what that meant was from where we got out to this place here, that was a it says a 52% drop, 51% drop, and we were able to avoid that. At least a big part of it, I would say. Now, I'm not telling you this to paint a picture that, we were brilliant or figured things out. This is just what wealth management's about, is trying to figure out what is the best move to do. It could have gone the other way. It could have broken up and went up there, and then we would have had to scramble to get back in again. There was all kinds of information we were trying to put together to help clients feel comfortable about where they were in the markets, to try to make the best of this. And the fact was, they still had income needs, they still had growth needs, they still had goals they were working on. And so working through this process was challenging. But here's what the driving force for me was through all of this, was simply this. If you have, and I'm using this number simply to keep it easy to follow, if you had $100,000 and went down 10%, you now have $90,000. If when you take that $90,000, if you can protect a lot of it and make it so it's available, and you get down here to this bottom somewhere where there's very specific reasons why you would reinvest at a certain time. We did not reinvest right here, I'll tell you that right now. It took a while for us to get back in again. It's probably another 6-8 months before we got back in. But if you are, instead of just following this all the way down with 50,000, you're following it with 80 or 90 or 75,000, it's much easier to take this and make money with it. It's much easier to climb out of a deep hole with more money than it is with less money. Another way to think about this is this. If you have $1 million portfolio and the market drops 50%, and the following year it goes up 50%, what does that mean? Well, let's do the math. $1 million portfolio goes down 50% is $500,000. If the following year goes up 50%, that's $750,000, because the 50% up was only based on the $50,000, not on the $1 million. So it takes 100% to get back up to the top again. And so minimizing loss is an incredibly important piece of managing wealth wisely when you're doing it in the capacity that we do it for families and their family wealth. So do I wish we could have done better in 2008? I do. Do I feel like we did a bad job? No. I feel like we did a great job. But there are things we learned from 2008 that have brought us forward to other times, which is where I'm coming to now. If we go back, let me see here, is this the one? No, I want to say that for later. So if we come back to here, we expect there to be another bounce up. I don't know when that bounce up is going to happen. I can tell you, I believe that what we're going to see is probably in the next 2 to 4 weeks. That's typically what will happen. And when that bounce comes up, it's either going to run into the 200-day moving average and turn back down again, or it's going to run into this 20-day moving average or the 50-day moving average and turn back down again. If it does, then we're ready to go ahead and become more defensive, and I'll talk more about what that means in a second as well. But that's the plan. And how much we'll do it, well, it depends upon clients' risk tolerance. Some of you are very risk tolerant. You're okay with risk, in which case we'll do less because we want to make sure we can find the best opportunities for you along the way. Others of you are very risk avoidant, so we want to make sure we choose to manage the portfolio in a way that protects your assets, because losing money is a terrible experience. Matter of fact, across the board, investors hate losing money 2 times as much as they enjoy gaining money. So we work really hard to make sure we can minimize that. So when this happens over the next 2 to 4 weeks, we're going to be watching, and what happens with it will determine what we do next. To be honest, I'm hoping that it goes right above, breaks through the 200, breaks through the 50 and the 20, goes right up here and takes off again. Nothing would make me happier than if this would be the case in the next 2 to 6 weeks. But I have to operate on the idea that that might not be what happens. And so we're working carefully to make sure we stay on top of that. So hopefully all these fancy terms, and I apologize for that, but hopefully all these terms give you at least some understanding of what we're seeing and give you some context for the decisions that we're making. And maybe even to the point where it'll give you some thoughts to call us or email us and say, hey, what about this? Or can we do this? Or how would you do this for your particular portfolio? Because this is what this is about, is managing money for you and your family's benefit.